Good morning, everyone. We'll just get a few minutes while people clock on for the attendees. Welcome to this Think webinar series on St Andrew's Day. So happy St Andrew's Day. St Andrew, the patron saint of Scotland. He's also the patron saint of Barbados, Romania, Russia, and the Ukraine. So maybe there should be a need for the patron saint to work some more magic in those countries. My name's Iain Craig. I'm BDO's Eye on Tax for obvious reasons. I've got my webinar waistcoat on and my webinar matching eye patch. I'm joined by my good friend Mark Lodder in Christchurch, and we're going to take you through some of the recent tax changes. We're called it St Andrew's Day special because today is St Andrew's Day, the 30th of November. I do apologise, Mark, coming originally from England. I didn't realise that England would be in the middle of the Soccer World Cup, playing their final round robin game at the moment. And Mark has suggested that he's happy for the scores to be updated. He will be trying to watch the game later on in the day. But as long as the score's not more than Wales beating England by 4 goals, England are probably guaranteed to go through, so he'll be reasonably relaxed. And he did say that if somebody says the score is 5-0 to Wales and you ask a question, he'll probably give the wrong answer because he'll be deeply upset at that stage. So we've got a lot to get through today. We are going to cover some of the tax items that are included in a huge tax bill called the Tax Omnibus. You know, the title is so long, I can't even be bothered trying to recite it, but it's a big bill that came out in August, September. It contains a whole raft of changes on GST, some of the most taxpayer friendly and sort of a sign of a maturing GST system. Mark will cover GST changes and some of those GST changes as they apply to some of your private assets like the boat, the batch and the BMW. I'm going to take you then through some of the property changes that are included in the bill, and before we will sort of have a chat around tax in inflationary times and some of the information that we've our thoughts on tax and managing your tax compliance while we're in an environment of inflation. We hope to have time for questions. We've got a lot to get through as we usually do. Mark and I do like to talk, but we will try and allow time for questions. The approach is to stick the questions on the chat box that our Jamie Maxwell in the backroom team will be forwarding those chat questions to us, and we'll try and deal with them at the end. So without further ado, I'll pass you over to Mark to go through some of these significant GST changes.
Thanks, Iain. A very happy St Andrew's Day to you. I'll just quickly say, if I cheer at some point during this webinar, it might not be because I'm delighted with a particular change that's forthcoming. It's probably more likely because Harry Kane scored and we're up. Very unlikely scenario based on the last game, but anyway. Right, I'm going to start off with a bit of information about Scotland. Scotland's national animal is the unicorn, interestingly. Iain wanted me to remind you that you would be mistaken if you thought the national animal was either a haggis or the Loch Ness Monster. It isn't, it's a unicorn. Right, moving on to the GST update. As Iain said, there are a lot of changes. They're quite sensible. They're moving into being, they look very taxpayer friendly, but make no mistake, a lot of them do help inland revenue as well. There's a lot of good connectivity between the changes as well. You'll see that some might be a backstop for another. And I have to say, from a personal perspective, they feel more well thought through than some of the other changes that have been purported, such as the KiwiSaver GST, etc., that had to be removed quite quickly. And I think this is one of the criticisms of the legislators or the policymakers at the moment, is that perhaps things aren't as well thought through as they have been. But these ones seem very sensible to me. But we'll go through them as and also there's a focus on the world changing, e-commerce, digitization, etc. And dare I say it, moving towards more simplification to allow our tax regime, our tax system to make life easier and digitise and remove the hand where we can. So in terms of the GST update, I'm going to start with simplification. We'll move on to talking about some fair things that we think are fair, and lastly, what's coming. So if we talk about simplification, the first thing that springs to mind, and this is current law, is there is no need for tax invoices. Tax invoices or holding a tax invoice is now a thing of the past. This doesn't mean you don't need to hold what we call taxable supply information. You still need to hold information on your system or wherever, but it doesn't need to be held in a single document with the words tax invoice written at the top of it. Still focusing on invoices over $1,000, invoices between 200 and under 1,000, and then you've got your under $200 invoices, which is a lift up from the information required where you're under 50 or 52, whatever number it was before. The taxable supply information that you need for the larger invoices, 1,000 and above, you need to hold somewhere. It will be on your accounting software system. Name and registration of the supplier, date of invoice, description of the goods and services, and then a price that includes the GST or a GST amount or something that shows value of supply, consideration, GST component parts. So all of those parts knitting in. Similarly, for your over 200s, under 1,000, we're just squeezing the information that's required. Under 200, squeezing it even further. I'd have thought from a practical perspective, you're probably not going to change too much. At the end of the day, you're still going to need good controls and measures to make sure that people just aren't just chucking stuff on the system. You're gonna want some form of recognition from a supplier, and a supplier's or a customer's going to want the same from you. You're going to need it for audit. But from a common sense perspective, isn't it nice that we don't have to answer questions from Inland Revenue saying, please send me all of your tax invoices that are over X number of dollars so that we can substantiate your input tax claim, only for Inland Revenue to come back and say, on a technicality, we don't like this because you haven't got the word tax invoice on this invoice, or they've spelt your name wrong. So this is a really good move in the right direction. Helps from a tax perspective, but we're still going to have it going on in the background for other reasons. The buyer created tax invoice. We see these from time to time, normally used when it just makes absolute more sense for the purchaser to be in control of issuing an invoice as opposed to the supplier. It's a bit topsy-turvy, but the purchaser, it might be the industry, the meat industry, I think, use the buyer created tax invoices a lot. It might be the purchaser just has got better systems or whatever it might be, but buyer created tax invoices, there's some sensible changes there as well. Historically, we have needed to get approval from Inland Revenue to use the buyer created tax invoice process. And then at the top of the invoice, it needs to say Inland Revenue approved. Don't need to do that anymore, but you do need to record the agreement between the supplier and the purchaser that the BCTI is going to be used. And you also have to give the reasons why why they're going down this process. So two good changes there, cutting through a bit of red tape, stops people from getting caught out inadvertently and having to backpedal or whatever to solve problems. So we like these changes. The principal purpose test, this is something that's not quite in yet. It's in the current bill, and it's back to an old friend. And from Iain's perspective, being back to an old friend is not Ivor McAndrew, but it's the principal purpose test. We do like the principal purpose test. At the moment, our GST Act revolves around being able to claim input tax to the extent you're making taxable supplies. This principal purpose test, or proposed introduction, is simplification. It's focused on purchases of goods and services less than $1,000. If your principal purpose is to make taxable supplies, claim away, you can claim all of the GST, you don't need to make any adjustments. It's an all or nothing test. So principal purpose, back within a threshold, under $10,000, What we'd love to see is we'd like to see, from an income tax perspective, perhaps a low value asset threshold be increased from, I think it's $1,000 again now. Maybe we follow suit and start pumping that up as well to be with the times, because it doesn't really apply to too many things. So by that, I mean the ability to claim an immediate deduction for assets for income tax purposes, depreciable property. At the moment, you can claim up front if you're under 1,000. Maybe we should be looking to increase that further. So there's some simplification. Moving on to fairness. And we've purposely put a question mark there because what's fair for one person might not be seen as fair to another. So we are being a little bit careful here, certainly with the last one. But I do want to add another Scottish fact, and I quite like this one because it really does link to the slide. But the Scottish National Party's vision is fairness. Their goal is to build a fairer Scotland, and I think that's very, very worthy. Good on them. So it links quite nicely to this slide. Right, second-hand goods claims. I think this is in the legislation as well. We've got law here now. This is a driver on the old game of associated persons and second-hand goods claims. So going way back, sorry, not even going way back. The law was, if you transfer an asset to an associated person and it's a second-hand goods scenario, i.e. the supplier is not registered and the purchaser is registered, then the purchaser will have a look at whether or not they can claim a second-hand goods input tax claim. Now, if the parties are associated, the rules were that the second-hand goods claim or input tax claim was restricted to the lesser of cost, the market value if it's different from cost, or the GST that was borne by the associated supplier. Now, if the associated supplier had purchased from a non-registered person, then there is no GST in that supply, and therefore from a second-hand goods perspective, associated persons, the input tax claim was restricted to nil. This has been perceived as not being equitable, and the rules have changed such that effectively the second-hand goods claim for the associated purchaser is restricted to the GST second-hand goods claim which would have been available to the person making the supply. So we're effectively standing, so it will be restricted to the cost of the supplier. This is another good change. We like it. It allows for more commerciality, because often we find that the inability to claim a second-hand goods claim precludes registered persons from using the right commercial structures to carry out their activities. Because if we were to sell the asset then and not have a GST claim, we're less likely to do it if we can have some form of GST claim or adjustment if we were just to leave it where it is. And sometimes that can lead to more complicated structures or uncommercial structures. So the second-hand goods claim, we like this. Increased input tax claims. Now, given it's a Scottish theme, I'm going to use the example where so this is where we have goods and services partially used for taxable and partially used for a non-taxable purpose. And I think this will be close to Iain's heart. But I'm going to take you back to Scotland, Iain. A person buys a house and they need a job. So what they do is they run a fish and chip shop from their front room. That's a commercial activity. So what they do is they say, right, I'm using 25% of my house to make GST supplies. I will claim a 25% input tax deduction. That seems pretty fair to me, and we like that. On the way out, when the house is sold with the fish and chip shop, there's an output tax liability. The way the rules currently work is it acknowledges that only part of the house is used to make taxable supplies. So what they do is you have a full output tax cost on the whole value of the house, but you're allowed a wash up GST input tax deduction, but that's only based on the original cost. So you've still got GST on the whole, or GST on the whole capital gain if there is a capital gain. The new rules are designed to mirror the position as though GST output tax is only on the 25%. So your input tax claim will be increased, not or based or calculated not on cost, but also on the market value on the way out. So that's another good change. Exempt, so moving more assets out of the GST net. Now, the holiday home really springs to mind to this one. So, Iain, I'm picking on you a little bit here, but I can't. My imagination is failing me. Iain acquires a holiday home in the middle of nowhere because he needs a place to play his bagpipes, and he's not very good at it. So he's got to go in the middle of nowhere because there's no one around to listen. But that's his principal purpose. He's thinking maybe in 2 years' time I'll spend more time there. But at the moment, this is going to be used as an Airbnb, and I'm going to have guests there, and so on and so forth. So he registers for GST and he zero rates the supply. So that helps his cash flows up front. He doesn't have a GST cost if he's bought from a GST registered person, or he can have a second-hand goods claim if he's bought from a non-associated party, etc. The problem is when Iain then goes to sell that property, he's brought the whole thing into the GST net. There might be adjustments along the way. Now, these rules to help people are going to move certain, or allow people to move certain assets out of the GST net, even though they might exceed the thresholds. So as long as Iain has acquired the property for principal purpose other than making taxable supplies, which is a yes, he's going to use it to play bagpipes. It's quite a frivolous spend, Iain, I have to say, just for bagpipes. But anyway, don't forget, principal purpose doesn't necessarily mean 50%, more than 50% use. It can have wider thinking. So as long as you haven't acquired for the principal purpose of making taxable supplies, you haven't claimed any GST deductions or zero rated part of the property, but running costs, rates, insurance, you can claim your fair share of GST on that, then you don't have to, there's no GST on the way out, and you don't have to have it as part of your taxable activity. There are transitional rules. So this, I think, is planned for 1 April 23. If you put yourself into the GST net and now you've got some sort of regret, there is a transitional rule which will allow you to pay back the GST you previously claimed or mitigated up until the 1st of April 2025. I think this one's quite a clever one from the Inland Revenue's perspective, because it's from a cash flow perspective, they're not in the situation, or they've removed the situation where they've got a large cash flow up front, and Iain may hold that property indefinitely, and the output tax might not be for a very, very long time, or not at all. And there's an example later where we'll just talk about output on the way out. But this one in particular looks really taxpayer friendly. We like it, but there does have a really good positive outcome for Inland Revenue as well, or the Treasury, in terms of cash flows. The last one, the gig economy, everything's going digital. We love saying the word digital. What does it mean? It means lots of different things. But this is about digital platforms such as your Airbnb, Bookings.com, Deliveroo. So persons who provide a service, and that service is effectively provided, or the customer deals with the digital platform provider. Now, the issue with this is potentially non-compliance, and for certain registered persons to be disadvantaged because they're dealing with all their GST, whereas your Uber driver perhaps isn't, etc. So what the rules are, or to make life easier, it's proposed to impose a GST, or for the digital platform provider to deal with the GST on behalf of all those persons that actually provide the service. So if you are a GST registered person and you're running through a digital platform provider, to prevent the double taxation, any supplies you effectively make to that service provider will be deemed as zero rated. So no output, we won't have a double output because that's dealt with by the platform provider. And then you'll be able to claim your inputs as normal. If you're a non-registered person, then immediately going, well, that's ridiculous. We're now being disadvantaged because I'm effectively being deemed to be GST registered. I'm under the threshold. How can I claim my inputs? This is dealt with by providing a flat rate credit of 8.5%, which your digital platform provider will apply to calculating how much return you should get for the services you've provided. So this is really, this one as well, when I say fair, obviously the digital platform provider, we are seeing and we are not, and we're expecting significant pushback in this regard. It's just they've basically put all of the GST burden for the service provider on the digital platform provider. That's more work for them. Perhaps they'll take more of a cut, I don't know, but certainly it's another person dealing with somebody else's GST affairs. There's also that point we're effectively deeming all persons to be GST registered and ignoring thresholds. That's quite a fundamental change. And the last thing, there's a lot of information that the Inland Revenue will get from this approach. But this is something that's coming. It's going to affect a lot of people, but certainly the digital platform provider, they'll take more interest than most. So what's coming? And this links back to the third of the 3 points I just made on exempt. Quite like this one. This is about that we've got a thistle. Thistles are pretty, and I think they're quite hardy as well, Iain. They can thrive and survive anywhere, but they're quite prickly. If you grab it, it can hurt. So the scenario here is we often see we've seen and experienced with land transactions, again in particular, that there's a lot of regretted choice. So if we go back again to the example where we'll use an example where we've got a lifestyle block, and the lifestyle block has got maybe, I don't know, 10 hectares of land and a dwelling on it, and it's quite expensive. And the person goes and talks to somebody and they say, well, why don't you register for GST, and you might be able to claim a bit of input tax, or you can zero rate some of the supply effectively, i.e. on the land that you're not really using or don't need as a dwelling. You could put olive trees on them. That's an old favourite. Or you might have some grazing for the nearby farmer, which gets you to a taxable activity. So that deals with a cash flow up front. But as I said, it often comes with regretted choice. And Inland Revenue has been quite hot on these types of registrations, whereby over the years, the taxable activity has either fallen off, stopped, and because of the fact that once if you deregister, you claimed your inputs up front, you now have an output tax based on market value on the way out. Prices have gone up, and it's really, really expensive to unravel. So there is a danger of either keeping GST registrations going, which shouldn't be kept, or non-compliance. And the revenue's quite hot on this. So there is a proposal to introduce a deemed supply for GST purposes at the time the property is sold, if you claimed a deduction or zero rated up front and you haven't returned GST either equal to or greater than the deductions claimed. Now, the spin from the revenue's perspective is we are aligning the GST output liability not to the point of deregistration, but with the cash inflow on the sale of the property. So that's a good thing. But you might end up paying more. There is certainly the regretted choice. You've smoothed your cash flows up front, so you ate today, but it's going to cost you tomorrow. So you've got to really be careful. Don't think about just today when you're planning for tax and your cash flows. You need to think about what's going on behind, and the revenue. I'd expect this to come. It is in bill form. It's a backstop to that exempt situation we talked about, i.e. if you don't take the opportunity to take the asset out of the GST net, then we are going to make sure that the output tax due on a disposal in the future is captured, whether you're GST registered or otherwise. So that's something that's coming and in the legislation, in the bill. So the boat, the batch, and the BMW, I believe, and I wanted to use a Hillman Imp because I think that's Scottish. But as Iain quite rightly pointed out, we talk about the boat, the batch, and the BMW in New Zealand. So we will stick with that. My fun fact from a Scottish thing, I told you I was going to interweave these in. Kilts were invented at the end of the 16th century. Braveheart was set in the 13th century. So the blockbuster film Braveheart isn't really true to historical events. I'm really sorry, everybody, but it's not necessarily accurate. We weren't that bad. Well, we probably were, but anyway. So the boat, the batch, the BMW, talking about mixed use asset rules. So a mixed use asset, that's an asset. So I'm pointing at my screen, but I'm pointing at the batch. We're probably really focusing on the batch here, but a mixed use asset is one which has a business use, a private use, and then for at least 62 days in the year, nothing happens. It's neither used for business or for private purposes. Now, these mixed use asset rules, they look at two of the component parts. So when you're working out your GST input tax claim, you look at your business use, and then you divide that by your business plus your private use. Because what was happening is when people were working out their input tax claims, you would include the unoccupied use as effectively being available for business, albeit not occupied, and therefore your claim goes up. So if we had an example where I've got 100 days business, 100 days private, and 165 days nothing, then my GST input tax claim would be 100 over 200. I ignore the 165. That's how I'd calculate it. They're proposing to change these rules, and there'll be reasons for it, because it's very hard to say, well, this is private, this was unoccupied. Replacing it with more of a fair and reasonable test. I don't know where it's going exactly, but repealing the complex, moving to more of a fair and reasonable test for input tax, and see where we go. So that's some GST changes. Sorry, Iain, I'll pass back to you.
Thanks, Mark. Yeah, I think those GST changes are really interesting. I think things like the GST invoicing, you've still got to keep all that information. It's just got to be somewhere else within your system. So if the word doesn't have tax invoice, then that, it's a common sense type of thing. But I think if we go back to my bagpipe example, that's one of my greatest regrets in life. I didn't learn the bagpipes, but my neighbours are quite happy about that. But I think there's an exercise to be done if you've got one of those marginal properties like a holiday home, that there's a bit of maths to do where you work out whether paying back the GST you've claimed over the recent registrations is a better outcome than, say, deemed disposal at market value under those last provisions. So interesting. Okay, Mark, I shouldn't let you go first because you always take up way too much time, so I'm going to have to shoot through all of this, but that's all good. I haven't checked the score, so I've got no idea whether you're still in the World Cup or not. Fun fact about Scotland, there's a tradition in Scotland of using the St Andrew's cross on fireplaces to stop witches coming down the chimney to do their mischief. So there you go. It's I thought that was quite a fun fact. Anyway, next, look, there's a lot of changes going on with property, and I'll just have a quick recap. So Charlene, if we can go to the next slide. So look, we've had a lot of changes in property, particularly with the residential rentals, and You'll see that I've used alliteration there with a recap the residential rental, or the 3 R's, which used to be important in education with the reading, writing and arithmetic, but never mind. So we've had quarantined losses. Our losses are being ring fenced on a residential rental property that came in about 2019. We've had the bright line go from 2 years to 5 years to 10 years now. And the recent proposal says that interest is not going to be deductible on assets that are rental properties that are acquired after 27th of March 2021. And it's interesting, I was looking at the 5-year rule, and that came in 2018. So we've only got a very limited amount of stock left where land that have been subject to the 5-year rule will be actually, no, that's not true, because it'll be 27th of March 2021. I thought it would be exiting the rules in March 2023. So look, what's happened is because they've made so many changes, that's created a whole lot of challenges around things like transitional rules, things like boundary issues, like when are you in the bright line, when are you not in the bright line, transitional rules, did you buy the property before the interest limitation, after the interest limitation, etc. They've always said that the main home exclusion is being preserved, but they have interestingly tweaked that main home exclusion, and this is the main home exclusion in relation to the bright line test, because bright line tests, the wording is slightly different. And if you, just in very simple terms, if you have a house that you've owned for 8 years, that you have sold within the 10-year rule, but say you were overseas for 2 years of that 10 years, you are not occupying that as your main home, then a portion of the gain that would be caught by the bright line will be taxed. So there's a straight proportionality now on that main home exclusion. There's also some limits on whether the number of times you can use the main home exclusion within, I think it's 2 within, you can use it twice within 2 years, unless you've got a regular pattern of buying and selling properties, in which case you won't be allowed to use it at all. Now, in this latest bill, they've extended some rollover relief provisions, and we'll come to that in a minute. But I wanted to just reflect on interest limitation, because it's the one that I think has caused the most controversy. So next slide. So I like looking at this table, because if you bought the property before 27th of March 2021, you still get an interest deduction based on a flow through. So at 1 October 2021, it drops down to 75%. For this 2023 year, you're still getting a deduction of 75%, but then it's gradually phased out as per the table. Now, there was a whole lot of exclusions that were included in there, which again creates these boundary issues or transitional issues. Rental properties that are used for social emergency housing, student accommodation, if you're a land business developer, or they created this new build provision as well, which we talked about in the last webinar that we did, then they're all sort of boundary issues that you've got to work out whether you qualify for those and can still deduct your interest. Now, they're quite prescriptive. So student accommodation, you only get it if you are supplying it through a contract with the university or the educational establishment. Social emergency housing, again, it's the same kind of requirement unless you register. Now, there was a lot of pushback on some of these challenges on interest limitation, and they introduced in this bill a new extension for build to rent, which I'll go to quickly. Now, the build to rent exclusion is a very limited exclusion available to big players in the rental market. It applies to land that's owned by the same person, and it can include contiguous land where there's 20 or more dwellings used or available for use as residential properties. If the landlord offers a long-term lease, a 10-year lease, and provides the tenant the ability to personalise the property, so they might want to do some adaptations to it, they're saying that will now be, the interest will be deductible to that. So the tenant doesn't have to take out a 10-year lease, but they need to be offered it. And there are provisions for notice periods for exempting, for exiting the tenant exiting the lease, etc. Now, the thing that gets to me is that we are creating artificial boundaries Why 20 or more houses? Why contiguous land? Let's say you've gone about your business of buying residential properties over a 30-year period, and you've bought 15 houses in a street and then 5 in another street. You've got 20, but they're not contiguous, and suddenly you can't get a deduction. But somebody who's bought a whole apartment block and got 20 houses gets there. So look, some of you will sit back and go, well, you've got 20 houses, then you're doing very well. So, you know, it only affects those. But it's giving that big player a benefit and being discriminatory against the mum and dad investors who are still supplying properties to them. It's a deliberate policy, but it creates these boundary issues, which becomes complicated. And believe me, the complexity is real. Next slide, please. So, but there are some good news in this tax bill, aside from the other, and this is that we've kind of introduced provisions called, or extended rollover relief provisions, and a rollover relief, and this is from the Bright Line test. So we used to have, the Bright Line didn't apply if you inherited a property on death, or you took out a property and sold it within the Bright Line period when it was as a result of a divorce or inheritance, right? So people transferring their property to a family trust or to a look-through company or to a partnership was going to reset the Bright Line and potentially capture a portion of a gain in there. So they've extended some rollover reliefs to deal with sort of close family trusts, look-through companies and partnerships, where effectively there's still the same owners there. And changes to rules on co-ownership, where you may be jointly tenants in common and then become partners or whatever. So there's some good provisions in here on the rollover, but the devil is in the detail, because not all transfers will qualify for rollover relief. What I mean by rollover relief is that the Bright Line date will stay with the original date when the owner acquired the property, and the cost will remain at the original cost of the owner. But and it will also apply for interest limitation rules. So if you do this transfer after 27th of March 2021, well, are you doing it now? And in fact, these rules apply from 1 April 2022. So if you do this transfer and you refinance at that point of transfer, you've got a new entity borrowing money, that is a qualifying loan. So it will be rolled, the interest limitation will be rolled over, and you'll still get to phase it out over those 4 years. So let's deal with the next example. Let's take Andrew, good Scottish name. Actually, it's Greek in origin, not Scottish. But Andrew buys a property in June 2022 for $2 million. He decides to get some advice. His circumstances are changing, and he sets up a family trust. And let's assume that the family trust qualifies as a rollover trust, and he transfers the property at market value for $2.5 million in June 2023. His circumstances change. Maybe he's getting married, he's got kids, he needs a bigger house, and he then sells it to a third party sometime later. The June 2024 is just an illustrative date, but sometime within the Bright Line, and he makes another $1 million on this. Now, you think that this is a rollover relief trust, and therefore we should qualify for this. But the challenge here is that because he's transferred it at more than cost to the family trust, that $500,000 that he is deemed to derive in June 2023 is taxable income to him, and would be returned in his taxable income under the Bright Line test. The whole 1.5 should be taxed under the Bright Line test, assuming it's not your main home exclusion. I'm assuming the main home exclusion doesn't apply, so this is a residential rental property. So he's got it wrong. He's done the transaction wrong. Now, the answer to this is Andrew simply has to transfer it at cost to the rollover relief to the trust, and then there will be no tax to pay at that earlier time. So the devil is in the detail. We've got to check the trust as a rollover trust, and you've got to do the transaction properly at that time. So moving on. There's been a lot of other changes in property, and we've Inland Revenue have released a an interesting decision called a technical decision. Now, a technical decision is where the Office of the Chief Tax Counsel has had a case come to them that's heading towards court, and they've come up with a ruling that said, actually, we think this is not worth going to court on, and that the taxpayer, and they've issued the reasons why they've made that decision. So the facts are broadly that a person was overseas at a time. They bought a property with the purpose of renovating and extending it to live in with their extended family. So it's going to maybe bring parents back from overseas or give them a place to live. He commissioned an architect to look at the property. There was serious problems with it, asbestos, drainage, and the architect recommended demolishing it and building 2 new houses under a subdivision with 2 new titles. You can imagine the work that goes on to do that, the resource consenting, the drafting, the building, the demolition, and all the process. So sometime later, it's successfully achieved, and he decides to sell one of the houses straight after he moved into the first one. So the questions that the Office of the Chief Tax Counsel looked at was, did the taxpayer enter into an undertaking or scheme with the dominant purpose of making a profit? Did they acquire the property with a purpose or intention of selling it? And did the residential land exclusion apply, and was the sale of the house subject to GST? Now, the interesting thing about question 1 is that is a section that deals with the dominant purpose of making a profit. And traditionally, we've looked at that as being to do with shares, personal property that are being acquired with the purpose of resale, and where there's a clear dominant purpose. It isn't part of the land transaction rules, but the revenue have considered it because there's clearly a series of steps, an undertaking or a scheme that comes together to create the property and then sell it. And the question was that CB3 can apply if there's a dominant purpose of making a profit. And in this case, the dominant purpose was held on the evidence that the purpose was to renovate and provide a living for their extended family. And so it didn't have a dominant purpose of making a profit. The second question is the land transaction rules of section CB6, which is the ones we've traditionally looked at for property. Did the taxpayer acquire the property for a purpose or intention of selling it? And here the difference is you don't need to have a dominant purpose, you just need to have one of the purposes or intention of selling the property. And in this case, that attention has to be applied at the time the person acquires the land. And that's right at the very beginning, when the purpose was renovating and extending it to live in, and before he consulted with the architect. So in the body of evidence, they said there wasn't a purpose or intention of selling that second house at the time they acquired the land. Interestingly, the third one, which is the residential land exclusion, the case comes out there and said, well, and this is in terms of CB12, so this is another section again that could apply, which is where you've got an undertaking or scheme which doesn't have the dominant purpose of making a profit, but involves work of a minor nature, of more than a minor nature, that commences within 10 years of ownership of the land. And so you look at that section, say, can it apply? Well, you've got an undertaking or scheme, you've got a subdivision, and you've certainly got work of more than a minor nature because you've got resource consenting, architect's fees, planning, building, construction, more than likely more than a work of more than a minor nature. So, but there is a residential land exclusion that can apply, and that's where you undertake that for the purpose of residing in the property. And interestingly, in this case, even though the person had never moved into the property, the activity that was undertaken was for the purpose of residing in the land. It didn't have to be occupied at that time. Now, that can be contrasted with the bright line main home exclusion that I mentioned earlier in the presentation, because that's specifically got different wording for the main home exclusion against the bright line. This is not the bright line. This is a simple subdivision involving work of more than a minor nature, but the residential land exclusion applied. And they also came up and said, well, and this is also an interesting fact, that the level of activity was not continuous or regular enough. It didn't reach the stage of being a taxable activity, and it wasn't compelled to register for GST and pay GST on that sale of the second house. So it's an interesting technical decision. It's available on the Inland Revenue's website, technical decision 22/21. Mark, you've got another slide on partitioning.
No, thanks, Iain. I think that case is important. I think it really does highlight that you think you're all right with one section of the Tax Act, but there are a few more behind it that can apply and catch you up. So I'm talking about the bill again, land and partitioning. I thought this was a good time to talk about Scottish independence, but I won't in the interests of time. So partitioning. So this is another taxpayer-friendly measure with land acquisitions. What we often see is two or more parties coming together and pooling resources to purchase land, and then at a later date or after they've purchased the land, they will then subdivide the land and each party will take their respective parcel of land that they always intended on purchasing. Now, under current settings, the subsequent subdivision and sale of the land will be treated as a disposal for income tax purposes, and you could end up with a tax liability. So from a tax planning perspective, we often end up with a whole heap of quite complicated legal documents involving bare trusts or different structures to try and get to a fairer outcome, whereby each party physically couldn't have bought the parcel of land that they wanted and therefore had to go through this process, but end up with an unexpected tax liability. These rules are far friendlier. The partitioning rules will merely remove from the definition of disposal these types of scenarios. Therefore, there is no disposal for income tax purposes. Therefore, there can't be any consideration or income from a taxation perspective. But this is providing the parties maintain the proposed percentages. So it's got to be in line with, I was expecting to take half and your half. You can't change it to 60-40 or whatever. So that's partitioning. We like it. I won't talk about Scottish independence. Back to you, Iain.
Yeah, thank you, Mark. There's some great. Look, there's some good relieving provisions in the bill. The challenge is the complexity around all of those rules, and believe me, I've waded through 215 pages of commentary on this bill, and I'm still think that every time we get a transaction, you're going to have to hit the books and hit the legislation and work through it and make sure that you qualify, because if you don't qualify, you'll be in deep trouble if you do the transaction and then ask for advice later. Next, we'll talk about taxation and inflation. I have got one question on property and land, but I'll come to that. I will have time to deal with that at the end. Look, I thought it would be a useful topic to see whether tax in this times of higher inflation, do we need to reset the way we look at tax and how we manage our tax compliance? So I did some research at the weekend, and I went on Dr. Google, and I came up with a Reserve Bank Bulletin report that was sent back in, written in 1989, which was probably the last time we had a really high area of interest rates and high inflation. And this was a Reserve Bank bulletin. It was quite an interesting article, and it was focusing on resetting of the tax systems. And some of the things I took out of it was, look, New Zealand has a nominal based income tax system, i.e. it does not adjust for inflation. Inflation can significantly alter the tax burden. It can distort your economic decisions, and it has obviously impact on saving and investment as your purchasing power of money gets, or purchasing power of your savings are eroded. The conclusion that came out of this Reserve Bank bulletin, and this was relevant to 1989, was that domestic residents, i.e. New Zealanders, would be discouraged from saving by the low after-tax real returns, because your return that you were getting would not actually constitute a real return because of the inflation impact. But it was also that businesses would be encouraged by the relatively real after-tax cost of borrowing. So a deduction for interest would be of more value up front if it was then used to acquire assets, where the assets might inflate in value and produce better returns later on down the track. But the challenge was set in 1989 was that domestic residents wouldn't save enough to give you enough money to be able to lend to the businesses. And so the kind of conclusion in that paper was that you'd have to borrow from overseas. Whether that applies when the whole world has got high inflation, and we've seen some data to show that, I don't know. But I also thought, well, surely there's something more recent than 1989. And again, the Google search came up with a presentation to the World Bank and the IMF in October 2022, which is, and there was 4 interesting presentations on dealing with whether you should reset your tax settings on things like food and energy prices. Should you change the GST system for inflation, and what are the sort of things that come up with inflation and tax? So I've chosen one of those presentations. The other presentations seem to say it is very dangerous to make changes to tax settings purely for inflation, but there are some ones that are obvious. The bracket creep, which has been talked about for many times when we didn't have really that much of an inflation, but the bracket creep is, more and more people earning more than $70,000 and paying tax at a higher level, but the $70,000 hasn't been adjusted for 10 years. So inflation naturally puts people in higher. As inflation gets higher, the pressure on that bracket creep becomes important. It becomes even greater. Inflationary gains are obviously taxed. Now, you say we don't have a capital gains tax in New Zealand, but we've got plenty of gains that gets taxed. We've seen it with the residential properties. You've seen it with the depreciation recovery income. You've got things that are bought with the intention of resale. You've got foreign exchange gains on forex loans, etc. So there's plenty of gains that are going to get taxed. And should you exclude the inflationary element from it in terms of the real time? The lowering purchasing power of tax refunds, there's incentives usually in the system to delay paying tax. I'm not sure that applies in New Zealand, where we've got a comprehensive use of money interest regime. But you're going to have higher costs of goods. Your value of depreciation will erode over time. And as I mentioned before, the cash savings are eroded. Now, what was interesting in this paper is how many countries adjust their income tax thresholds to deal with bracket creep. Now, 131 countries make no inflation adjustment of it. Some of them do an automatic one, like Austria, Canada, Netherlands, etc., United States, and others do an unclear process, so they might just do it from time to time. So, without being political about it, the bracket creep has been growing for a long time and inflation is grating. It's like an easy win to adjust for inflation. Whether you need to do it or not, I guess depends on whether we think we've got high inflation for a long period of time. So I went to the Reserve Bank presentation, the monetary policy statement in November, and their forecast came up. So Charlene, if we can, yeah. So this is straight from the Adrian Orr's presentation, and they're projecting that the interest inflation will continue around 7 to 8% until mid next year. Eventually, the impact of interest rates will start to come down, and the inflation will come down, and we'll be sitting around 4 or 5 at 2023, 2024, and eventually they obviously want to get it back down to 2% because that's their target. So that's their hope that they're going to do it. So maybe it's not such a long-term issue, and it's not endemic in our economy, and it may not be here for stay. But I think we need to watch this space. So the tax tips and lessons learned from previous was, it still comes back to good management of your tax system. I don't think you need to reset your way in which you manage tax just because of inflation. I think as I say, we've got use of money interest and penalties regime that tries to impose incentives on people to comply with their tax. You've got to manage that carefully. I think, if the economy starts to tank and you get into trouble, be very careful about making sure you try and meet your GST and PAYE obligations ahead of income tax, because they are monies held on trust for the Crown. And if you're in trouble, apply for a formal debt repayment program in advance, and we can assist you with that. Evaluate your capital investments clearly. Look at that decision as to whether you can increase your borrowings to invest in capital assets, etc., and will you get a proper return. And lastly, I'm going to say that be aware, inland revenue, and Marcus touched on this with the digital economy, inland revenue are increasingly connected through the IRD number and their computer systems. internationally, the amount of data that is being shared around the world is enormous, and the idea of having something off the books that you can't see and not be found out by the Inland Revenue is not valid anymore. So if you've got concerns around your tax, please contact your BDO advisor. Best tip I can give you, and we're happy to help. Now, questions. We've only got a few minutes to go. The first question I got was, what happens when a batch gets transferred out of an LTC to the individual? Does the bright line reset, even though the LTC director is the same as the individual? So I think that the test, and this is where the devil is in the detail, but I think the test is if the property was originally owned by the individual who put it into the LTC and it comes back out of the LTC to the individual, that will be fine. That should qualify for the rollover relief, but you should check it in detail. If they didn't own it and the LTC was formed and bought in the first place, I think it should qualify, but I would want to check the exact wording in those in that legislation.
Yeah, there's another one on a similar vein, but I just want to make the point, Iain. I think you've coined a new phrase with tax threshold, which is quite.
Did I misspell it?
No. You said threshold when you were talking, and then corrected to threshold. But I think a threshold is quite appropriate in these inflationary times and bracket creep. But we have another question on rollover relief, and it's a transfer to Andrew's family trust. You said you should have sold at the same cost he purchased for. The question is, but because we sold to an associated party, wouldn't Inland Revenue just look through this and deem it to be sold under market value? That's a really good point, because ordinarily, if you go against market, Inland Revenue will impose or deem market over the top. However, in this case, purely for these rules, so it's just for bright line. Don't forget, if there's another taxing provision that applies, then you could go to market value, but let's assume nothing else applies. There is a suspension of this imposing market value or deemed market value where you are looking for rollover relief. So it's a great question, but under this bright line, we can do it at cost. The market value is suspended effectively, and I think there's a legislation fix there. But there could be another provision that captures you. You've got to think it through.
Yeah, it is. And it's for the residential rental properties. So, perhaps you've got a depreciation income issue that's coming in, but they've actually want you to transfer it at cost, and that's clear in the legislation. So, yeah, it's good. So, any other questions? I know we've rushed through.
I've got another one on second-hand goods, just to make it really clear. I think this is from Ben. Thanks for the question, Ben. The question's around second-hand goods claim, and his example is a building's been sold by a non-registered person. The person buying it is GST registered. Can I still claim GST on the building? There's an interpretation that maybe I can no longer claim. Now, providing the building is a commercial building and we've got taxable activities, etc., being run from it, you can claim your second-hand goods. There is a second-hand goods claim available to you. The point is, if the transfer was a non-registered to a registered and they were associated, it's those rules on how much you can claim which has changed, and they are more taxpayer friendly or registered person friendly. But your pure question, yes, you can still claim an input tax under second-hand goods claim, but we just need to understand what's the amount and is it restricted.
Yeah, thanks, Mark. I'm just going back to my batch question in the LTC. The other thing about that is that those provisions, I think, are coming in at 1 April 2022. So don't take it out of your LTC before 1 April. Oh, no, 1 April 22. Yeah, I was at 2023.
There's one of the questions was when do these all take effect? Now, as Iain said, the commentary to the bill alone is over 200 pages long. There's a lot more things in it. So we've gone through certain things, not all things. The dates are all over the place. We've got some dates 1 January 24. We've got some dates 1 April 23. We've got some things we talked about which are already in, like tax invoices, the buyer created tax invoice, second-hand goods, etc. So there's a hodgepodge.
Yeah, and some of them are backdated to 1 April 2011. Some of those GST relieving provisions. So yeah. I guess, again, without wanting to sell it, please check with your BDO advisor rather than rely on a comment from here, because you don't want to get it wrong. Look, thank you for your time. We've had an enormous number of attendees at this St Andrew's Day special. I hope we've shared you some fun facts of Scotland and St Andrew. And I do find it funny that most of the fun facts came from the English. Well, we're all Kiwis, right? So I've been in New Zealand far longer than I lived in Scotland. But you can take the boy out of Scotland, but you can't really take Scotland out of the boy. So, and the same is true for Mark. So thank you for attending all our BDO webinars, but particularly from Mark and I, thank you for attending the 2 that we've run this year. We look forward to bringing more Rethink Tax webinars next year to you. And at the moment, we just wish you a very safe and relaxing time with your family and friends over the festive season. Thank you.
See you guys.
Merry Christmas.